It began quietly. A subtle shift in the numbers buried deep inside U.S. Treasury auction data. Fewer bids, smaller volumes, and a growing gap between what Washington wanted to raise and what the market was willing to buy. Then, over several consecutive auctions, the trend hardened into a headline: foreign investors are pulling away from U.S. government debt. For decades, U.S. Treasuries have been the ultimate safe haven, the financial bedrock of the global economy. Yet, in recent weeks, overseas demand has faded at a pace not seen since the early 2000s. The timing couldn't be more dramatic. While Washington struggles to lure buyers with higher yields, Beijing is borrowing at the lowest rates in its modern history. In a rare twist, global capital is finding Chinese debt, long considered riskier, increasingly attractive. And as foreign funds shift east, the symbolism is unmistakable. The world's financial gravity may be tilting. On Wall Street, bond traders speak of a quiet exodus. In policy circles, alarm bells are ringing. This isn't just a fluctuation in investor sentiment. It's a potential turning point in the balance of global financial power. And it's unfolding in real time. For more than half a century, U.S. Treasury bonds have been the backbone of the global financial system. They are considered the ultimate safe asset, backed by the full faith and credit of the United States government. Central banks hold them as reserves, pension funds rely on them for stability, and foreign governments use them as both an investment and a strategic store of value. In times of crisis, money almost always flowed into treasuries, pushing yields lower and reinforcing the dollar's role as the world's reserve currency. From the oil shocks of the 1970s to the global financial crisis of 2000, foreign investors, from Tokyo to Riyadh, have historically accounted for a significant share of U.S. debt purchases, often absorbing hundreds of billions of dollars worth each year. Their participation not only kept America's borrowing costs low, but also signaled global confidence in the U.S. economy and its political stability. That is why the current retreat is so startling. A sustained pullback challenges the assumption that demand for treasuries is inexhaustible. If global buyers begin to question the safety, yield, or political reliability of U.S. debt, the ripple effects could reach every corner of the world economy. The exodus from U.S. Treasuries did not happen in a vacuum. Over the past year, a series of converging pressures has chipped away at the global appetite for American debt. Rising interest rates driven by the Federal Reserve's fight against inflation have pushed borrowing costs to levels not seen in decades. For existing bondholders, that means steep losses as older, lower-yield treasuries lose value. At the same time, political brinkmanship over the U.S. debt ceiling, complete with threats of government shutdowns, has introduced a rare sense of uncertainty about Washington's fiscal reliability. For foreign governments managing billions in reserves, even the perception of instability can be a reason to look elsewhere. Meanwhile, the dollar's recent volatility has made treasuries less attractive as a safe haven asset, and as the U.S. runs historically large deficits, the market faces a wave of new debt issuance that could further depress prices. China's move to issue bonds at record low rates offered a stark contrast. Investors searching for yield stability saw Beijing's issuance as a rare combination of security and predictability, especially as China signaled a willingness to back its debt with strong central bank support. The result? A quiet but steady shift in global capital flows. While Washington wrestled with rising yields and declining demand, Beijing unveiled a bond issuance that caught global markets off guard. In a series of high-profile auctions, China's Ministry of Finance offered government bonds at interest rates so low they set a modern-era record, in some cases below the yields on comparable U.S. treasuries. The success of the sale wasn't accidental. China had carefully cultivated an environment to reassure investors. Stable inflation figures, a supportive central bank, and clear commitments to fiscal discipline. State media amplified the message, framing Chinese bonds as a safe and steady alternative in uncertain times. For many foreign buyers, particularly those in Asia and the Middle East, the appeal was twofold: competitive returns paired with reduced exposure to U.S. political risk. Sovereign wealth funds and institutional investors moved quickly to secure allocations, viewing the record-low borrowing costs as a sign of Beijing's growing confidence in its economic stability. The optics were as powerful as the economics. In a single stroke, China demonstrated it could draw substantial foreign capital without offering high yields. while the US struggled to maintain its investor base even with elevated rates. It was a subtle yet unmistakable shift in financial momentum. The ripple effects in the United States were immediate and unsettling. With fewer foreign bidders at Treasury auctions, Washington was forced to offer higher yields to attract buyers. That meant the cost of servicing America's debt, already at record levels, began climbing even faster. Every percentage point increase in borrowing costs translates into tens of billions of dollars in extra interest payments, straining an already stretched federal budget. Bond traders noted unusual volatility in the days following China's record low issue. Treasury prices slipped, yields surged, and the dollar wavered as investors questioned whether the risk-free reputation of U.S. debt was as solid as it once seemed. For U.S. corporations, the shock reverberated through credit markets, raising borrowing costs for everything from infrastructure projects to mortgages. Politically, the optics were damaging. News headlines contrasted Beijing's smooth, oversubscribed bond sales with Washington's increasingly expensive auctions. For critics of U.S. fiscal policy, it was ammunition to demand spending cuts or structural reform. In a single week, the narrative shifted from American financial dominance to a more uneasy reality. The world's largest economy now had to work harder and pay more to fund itself, while a major rival was borrowing at historic lows. The global response to the shift was swift and telling. In Europe, financial analysts warned that the retreat from U.S. Treasuries could disrupt dollar-denominated trade flows, making borrowing costlier for nations dependent on the greenback. Several Asian economies, particularly those tied closely to Chinese supply chains, saw the move as an opportunity to deepen financial cooperation with Beijing. In the Middle East, sovereign wealth funds quietly rebalanced portfolios, increasing exposure to Chinese debt while trimming U.S. holdings. Even allies of Washington acknowledged the symbolic weight of the moment, a sign that the world's financial center of gravity might slowly be shifting eastward. Meanwhile, emerging markets took note. For years, they had followed a default strategy of parking reserves in U.S. Treasury. Now, China's example hinted at a new model, one where economic influence was measured not only by exports and GDP, but by who could attract the world's capital most confidently. If the current trend accelerates, the consequences could be profound. A sustained foreign withdrawal from U.S. Treasuries would force Washington to offer even higher yields, inflating debt servicing costs and deepening fiscal deficits. In extreme cases, it could weaken the dollar's reserve currency dominance, eroding America's leverage in global trade and finance. China, meanwhile, could leverage its new position to expand its role as a lender of choice for developing nations, tying more countries into its financial orbit. This would not only boost Beijing's geopolitical influence, but also challenge institutions like the IMF and World Bank, where the U.S. has historically held sway. Markets would likely grow more volatile, with interest rates in the U.S. becoming more sensitive to foreign sentiment. The once unthinkable scenario, a global economy less reliant on American debt, could shift from distant theory to unfolding reality, altering the balance of power for decades to come. The numbers tell a story, but the symbolism tells an even bigger one. For decades, U.S. Treasuries have stood as the gold standard of global finance, the one asset the world could trust above all else. Now cracks are beginning to show, and China is stepping into the space those cracks have created. This isn't just about bond yields or borrowing rates. It's about perception, power, and the subtle shifts that reshape the world order. If investors continue to choose Beijing's bonds over Washington's, it could mark the beginning of a new financial era, one where America no longer sits unchallenged at the center of the global monetary system. The next auctions, the next policy moves, the next headlines will tell us whether this is a passing tremor or the first real quake in a century of U.S.-led finance. The clock is ticking.